Rohr here with an early global view on Tuesday, the 21st of April, 2015. It is currently 7 a.m. U.S. Central Time, and there have been quite a few macro factors that have affected the market of late, mostly weak data, but nothing quite so much as the Chinese indication they were cutting their reserve requirement ratio over the weekend into Monday morning. More on that soon. So, what does all that mean to the markets? Well, of course, all the data is negative, so there's not much else the markets can do but have the S&P be up $9, right back up to 2100, which is very interesting because that's right where it started out from last Thursday before the major gap lower last Friday on the sustained Greek concerns. Actually, this little bit of a gap lower Thursday was on the idea that is sustained now that Greece is going to have trouble meeting its debt repayment obligations. Those are quite substantial over the near term, so for all it made its one-off $450 million euro repayment to the IMF last week Thursday. We've got wages and pensions end of this month, a couple billion euros. Through early to middle May, you've got repayments to the IMF and to the various T-bills maturing that amount to another, approximately 5 billion euros or so. So it's going to be trying in the data side, but in the current bad news is good news environment, that just means more assured and major central bank accommodation, and especially QE from the ECB, Bank of Japan, and in its way, they said QE in China doesn't mean they're going to buy any bonds. It's more like quite easy. That's actually a quip from one of the officials in China. So being back up here, though, what does it mean? Well, in the intermediate term, 2100, the old highs up at 2107 in the contract, and the highs up at 2117 in the lead contract high going back into February are the important levels. On the way back down, the 88 to 90 previous support that was also a down break on that gap lower Friday is now the key support. You'll notice even on the pressure late yesterday, the market only got back down around the top end of 2088 to 90, below which you're looking at the potential move back into that 2075 to 78 area that's been so important. Even though it leaked out below it Friday, coming back to close, there was a sign the market was stabilizing. And no particular aggressive indications unless the higher opening today starts putting the hourly MACD out through the upper runaway band. So that's it for a little bit lengthier review due to the need to cover the background for the short-term view of the S&P 500.